Hey everyone, welcome back to the channel. Today, we're diving into one of the most important financial concepts in the U.S. economy, the federal funds rate. Whether you're taking out a loan, saving money, or investing, the federal funds rate plays a huge role in your financial life, and understanding it can help you make smarter money decisions. So, let's get into it. Let's start with the basics. The federal funds rate is essentially the interest rate at which banks lend to each other overnight. But here's the key part. It's set by the Federal Reserve, or the Fed, which is the central bank of the United States. So how does a rate set between banks impact your day-to-day life? Well, the federal funds rate directly affects the prime rate, which is what banks use as a basis for setting their interest rates on things like mortgages, personal loans, and credit cards. When the Fed raises the rate, borrowing costs go up, making it more expensive to finance a house, a car, or a business. On the flip side, when the Fed lowers the rate, borrowing becomes cheaper. Why does the Fed keep tinkering with the rate? It all comes down to two main objectives: controlling inflation and promoting employment. When inflation gets too high, the Fed raises rates to slow down spending and borrowing, which helps cool the economy. When the economy is sluggish, the Fed cuts rates to encourage borrowing and investment. In the U.S., many adjustable rate mortgages and loans are tied to the prime rate. Let's look at a practical example. Imagine you have a 30-year, $500,000 five-year adjustable rate mortgage. For the first 5 years, your interest rate was fixed at 6%, and you'll be paying around $2,974 per month. But now it's about to reset. The new interest rate will be based on the Fed's current interest rate plus a 2% margin. If the Fed raises rates, your ARM rate could increase to, say, 7%, and your monthly payments could increase to $3,293. But it's not just mortgages. Lines of credit and some credit cards are also linked to the prime rate. As it fluctuates, your interest payments on debt can rise or fall, impacting your overall financial situation. Now, what about investments? The prime rate can also influence the returns on safer fixed-income investments like CDs, certificate of deposit, or bonds. When the prime rate rises, interest rates on these types of investments tend to rise as well. This makes them more appealing, especially if you're looking for stability in your portfolio. On the other hand, higher interest rates can cool down stock markets. When borrowing becomes more expensive, businesses may scale back expansion plans, and investors could shift to safer, interest-bearing investments. So if you're an investor, understanding where the prime rate is headed can help you decide when to focus on stocks versus bonds or CDs. The federal funds rate is not static. It fluctuates based on economic conditions. Let's take a quick look at its history. After the 2008 financial crisis, the Fed slashed the rate to nearly 0% to help stimulate the economy. As the economy recovered, the rate slowly crept back up, eventually reaching around 2.5% by 2019. In 2020, in response to the COVID-19 pandemic, the Fed cut the rate again to nearly 0 to prevent economic collapse. Fast forward to 2022, and in response to rising inflation, the Fed embarked on a series of aggressive rate hikes, pushing the rate to its highest level in more than 20 years. But we're seeing a slight downtrend in recent months as the Fed signals a more cautious approach. This means that while borrowing costs have been high, we might be heading towards a more stable period with gradual rate reductions on the horizon. Whether you're managing debt or investments, keeping track of the prime rate is crucial. For borrowers, locking in a fixed-rate mortgage or loan can provide stability, protecting you from rising rates. For investors, diversifying your portfolio with both fixed-income products like CDs and growth assets like stocks can help you weather the ups and downs of interest rate changes. By staying informed, you'll be in a better position to make decisions about both your borrowing and investing strategies. Thanks for watching. I hope this video helped you understand how the federal funds and prime rate works in the U.S. and why it's important for both your debt and your investment portfolio. If you found this video useful, don't forget to like, subscribe, and share it with others. See you in the next one.